Well, hello there, folks. Brantley Whitley and Brandon Roberts here from the insuranceproblog.com. On YouTube today, we typically do a live show on Facebook, but we just decided to things up. Today, we're going to talk about life insurance policy loans. I'm sure that everyone was holding out over their holiday weekend for some hot loan talk, as I like to call it. But if Brandon will talk, he will appear on the screen, I believe, if we got all the stuff set up, right? Brandon, you there?
Yeah, I'm here. I don't know if we can tell who is appearing on screen or not. Maybe for the rest of today, they're going to stare at you and whatever facial expressions you make while they hear me somewhere ominously. That'd be
I'll
kind of
try
fun.
to remember not to pick my nose the entire time. That would probably be a good thing.
Yeah. So you want to talk about life insurance policy loans today?
Let's do it. Some hot loan talk.
We kind of come intending this to be more of a general introduction to loans so that people understand what they are and how they work.
Right.
We get a lot of questions about loans and loan functionality, right?
Yeah, well, we definitely do. I mean, there's a lot of talk in the life insurance zeitgeist, let's call it, about policy loans. A lot of misunderstanding, a lot of misconceptions, and some information that's just plain wrong.
Yeah.
In theory, this is something that shouldn't be that complicated. And I wouldn't say that it's necessarily terribly complicated, but navigating each life insurance company's process for life insurance policy loans is it's different.
Yeah. So let's start with the most basic. You can take a loan from a life insurance policy when there's cash value.
Well, there we go.
Seems very straightforward, right?
Yes.
For the most part, that's true. There are a couple of companies out there that require the policy to be enforced for a certain period of time. Most of those situations require the policy to be enforced for 1 year. And provided that it is enforced for 1 year or longer, you can take a policy loan. You can always surrender cash values from a life insurance policy prior to that in most cases. But in a couple of circumstances, you'll need to have the policy enforced for at least 1 year before you can take a loan. Everyone else basically says if there's cash value available, you can lend against it.
Right.
So that's a critical step. You gotta have cash value to take a loan, which some people might think we're being very sarcastic about. But there's a number of people out there who will ask, how much money can I take a loan out against my term insurance? And the answer is none, because it doesn't have any cash value. Or they'll buy a not very cash heavy focused product, like a long duration paid up to whole life policy or a guaranteed universal life insurance policy that really doesn't have any cash, at which point in time there is no loans available. So
that can be a major disappointment if someone is paying, I don't know, let's say $20,000 a year in whole life insurance premiums, and it happens to all be base premium, and they want to take a $10,000 loan after 2 years, only to find out, well, I paid $40,000 in premiums, but I have $1,500 in cash value. That can be,
that's
a little demoralizing, right?
Yes. So the loan itself, I want to be clear about something, does not come from the cash values inside the policy. The loan is actually issued by the insurance company, and your cash value stays put. That's important because the cash value that remains in your policy continues to grow.
Right.
It continues to grow at least the guaranteed rate of accumulation. And in many circumstances, there is non-guaranteed growth in that cash value. The exact amount will depend on company specifics. And this affects both universal life insurance and whole life insurance. Sometimes there's different loan options available that will impact how the cash value grows. And sometimes it's just a policy provision. In the whole life world, that's the direct recognition versus non-direct recognition discussion. But know this, regardless, the cash value will grow, at least as guaranteed rate, and usually some element of non-guaranteed rate as well. So when you take a policy loan, it's not like you're withdrawing the money and giving up any growth that you would have got on it. You could think of it in terms of home equity. When you take out a home equity loan, that doesn't mean that the value of your house won't appreciate by virtue of having pledged it as collateral. It continues to grow regardless of the fact that you have a loan out there pledging that asset as collateral for it. Obviously, it doesn't function identically to the way an equity loan does, but That's an analog for some people to sort of get that concept that you can take money from whole life insurance or universal life insurance, and you do not have to necessarily give up what was accumulating in terms of cash value inside the policy.
Right. And the good news is, if we're going to carry this analogy way too far, as I like to do, a life insurance policy, I would say, is more similar to a HELOC than an equity loan, right? Because you can tap it. You don't have to go through some long drawn out process of being approved to get your hands on the money.
Correct.
Some insurance companies make it a longer and more drawn out process than others, but there's no credit approval that's required.
Correct.
So
let's walk through the process
right
for establishing a loan. Because if you've never done it before, I'm sure if you own life insurance with cash in it, or you're contemplating buying life insurance and focusing on the cash buildup of it, or if you're an agent who's never overseen the process of a policy loan, I'm sure you're interested. So step one, you request a loan. Usually that request goes to the insurance company and they process the request, and it takes a couple of days. Sometimes a week or so. They usually think of it in terms of business days, and I think somewhere in the neighborhood of 5 to 10 business days has become the average. It's taking a little longer for loans to be processed these days than it did a few years ago, but that's just the way things work.
We have any wild speculation on why that is?
Systemization and the adoption of such, and the getting used to those systems is probably some of that.
Right.
It could also have to do with a greater number of people focusing on the use of their cash inside life insurance policies.
Yeah, that's my suspicion. I think it's just more popular.
Anytime we come to a point in the year where lending activity increases, say the holiday time period, or anytime we have a more troubled economy, we definitely see more lending activity against life insurance policies, and that would absolutely slow down the processing time because there's a lot more requests.
Yeah, well, we certainly hope at those times where there's some sort of economic downturn, we hope that our clients are able to take loans, or this is sort of our hope when they set the policies up, that they're able to take cash during those times to seize on other opportunities.
Yeah.
To buy distressed assets, whether that be real estate or other investments that they'd like to make. And I'm using investments not in the SEC investment world. I'm using investments as a general term. So
that brings up a good point. That just a little tiny aside. I don't want to spend a lot of time on it, but when we have bleaker economic times, we could have lending activity not just from people who have lost their job or lost their bonus check or whatever it is, who need some cash from a life insurance policy to carry forward, but also we have lending activity from people who are seizing on opportunity because of the decline in asset prices and a desire to buy in at a low time.
Right, and life insurance for those people in a lot of cases serves as a place to warehouse money that they can get their hands on in a relatively short order. So.
Yep. So once processed, the life insurance company sends the money to the policyholder. And that can happen a couple different ways. Could be a check that's mailed to them. Could be sent over electronically through an EFT. If for some reason the policyholder requests it and is generally willing to pay the fee, it can be wired. But EFTs being what they are today, the wiring of money is pretty low use.
Pretty rare that we encounter that. Yeah, pretty rare.
And then the policyholder has the money. And the policyholder can do with that money whatever he or she sees fit to do with it. The insurance company is not going to send a payment booklet or any sort of repayment schedule to the policyholder. And this is a critical aspect because a lot of people think it's a loan, therefore I'm going to need to make a repayment to it. And in the most absolute terms, yeah, it'd be a good idea to make a repayment to it, but it's not required in the same sense that a traditional bank loan makes it required. You will not receive any sort of repayment schedule, and loans that are issued from life insurance companies are not amortized in the same sense that they are from a traditional bank loan. Life insurance policy loans accumulate interest in more of a simple interest aspect that is assessed against the policy once per year. Now, depending on the type of life insurance policy you have and the way that interest is charged or accumulated, it may differ. Some insurance companies charge interest in advance. So
Right.
as soon as the loan is originated and at the beginning of every single policy year, the insurance company just assumes that the loan will continue for the rest of the policy year and they will charge all of the interest up front against the loan.
Right.
Other insurance companies charge interest in arrears, and that functions a little differently. What happens is the insurance company takes the loan balance and they take the loan interest rate and they divide the loan interest rate by 365 and they assess interest against the loan balance on a daily basis. So
Right.
whatever that quotient is, loan interest rate divided by 365 becomes the number that is multiplied against the daily loan balance, and that amount of interest accumulates each day. And at the end of the policy year, the insurance company sends the policyholder a notice saying, this is the loan interest that is accumulated for the year. You have two options. You can pay it, send us a check. This is the amount that you'd have to pay.
Right.
Or we can just add it to the loan balance that already exists. If you do nothing, we'll add it to the loan balance that already exists.
It will just accrue.
I want to just take a moment to pause and point something out, because some people hear us say that the loan interest accumulates daily, and they don't hear accumulates daily. They hear compounds daily, and they go, oh my God, that's terrible. No. It doesn't compound daily. It compounds annually if it's added to the loan balance, but it accumulates daily. The significance of that is if you pay down the loan throughout the policy year, and any payment you send to the insurance company for the loan purpose is going to pay down balance, not going to go towards interest. That reduces the amount of interest that is accumulating daily each time you make a payment.
Right.
So if your loan balance is $10,000 today, but you make a loan payment today of $1,000, that means tomorrow the calculation is $9,000 times that quotient of loan interest rate divided by 365.
Right. Yeah, it's very important. And when when you're buying a policy, particularly if you're planning on using it as a source of supplemental retirement income in the future. So in many cases, most people who are planning to do that are also planning to never repay their loan, right? So that can become an issue. I'm not saying, I guess I wouldn't declare that a policy that charges interest in advance on loans is always better than is always inferior to a policy that charges in arrears. But it's something you should be aware of. You should know when you buy the policy, if you're planning to use policy loans, obviously, you want to know which way is the interest charged so that you're sort of mentally prepared for that, and you can make plans accordingly if you want to pay it back.
Yep. Couple of other things to note. We already touched on briefly that there is no payment booklet. There's no payment specifically required.
Sure.
So if you don't make payments to the loan, it'll continue to accumulate interest once per year.
Right.
And either the loan balance will grow to a point where it's larger than the cash value in the policy, and the life insurance policy will lapse. Or you, the policyholder, will surrender the policy, receive whatever the net amount of cash is. So gross cash minus the loan, that difference is now yours.
Yeah.
But do understand that if the loan itself represents any amount of gain from the policy, there will be an income tax liability for that. Or you die. And when you die, what happens is the insurance company looks at the loan balance and your death benefit. They pay off the loan balance, and the remainder there again goes to whomever you have named as a beneficiary. And in that circumstance, there is no taxes ever due because of the outstanding loan.
Right.
So that's what happens if you don't make any payments towards the loan. If you want to make payments towards the loan, you can make payments in any sort of frequency with any sort of amount you want to, within certain parameters. There's always a minimum amount that the insurance company will accept, and that's because they really don't want to have to process a lot of $1 or $2 checks all the time.
Right.
But you can't
send in a bucket of your pennies and pay your loan interest.
You can send in, for example, a payment of $1,000 one month, $300 the next month, $2,000 the following month, nothing for the next 3 months, and then $500 after that. The insurance company really doesn't care. Also available to just about anyone with any major life insurer is the ability to set up an automatic payment towards a loan through an EFT. So you could, if you wanted to, establish an EFT repayment where you're paying whatever set amount you decide on to the insurance company each month.
Yep.
Or you could simply wait and do it once per year.
Yep.
and make a payment towards the balance, the interest if you want to.
I would just add that we've seen all combinations of
Yes,
everything in between.
It's and a lot of people get hung up on what's the best way to do it, and there really isn't a best way. The answer, or the consideration for best really has to do with the circumstances of the individual. What's best for you? What's going to work out best for your finances, your timing of cash flow, any of those things. That is what will matter, and that's kind of the beauty of the whole system. You can work it out to whatever you want to. You could take out a loan and go several years without making any payment and then start making payments. You could take out a loan and make several years of payment, stop, and then begin again. The insurance company doesn't care. And you also should know that life insurance loans have no public element to them from a credit worthiness point of view.
Crucial detail there.
Yes. Taking out a policy loan against a life insurance policy is not something that gets reported to a credit bureau. It's not something that impacts your credit by virtue of originating it. It's not something that impacts your credit if you don't pay it. If you were to take out a life insurance loan and ultimately lapse a life insurance policy because you never made any repayments, that doesn't get reported to anybody. There's no consequences from credit worthiness for that moving forward. It's a collateralized loan. So if you don't pay it, and the value eventually reaches the entire amount of the underlying asset that can be pledged as collateral for it, the insurance company is just going to cancel the policy and take the cash value that accumulated inside your life insurance policy.
Right. The asset in that case being the cash value. That was what they collateralized the loan with. So
Yep. So there's no public element to this, so it will not impact your credit worthiness should you go out and borrow money from a bank in some other fashion. So if, for example, you happen to use life insurance policy loans to buy automobiles, you don't have to report the outstanding loan on your life insurance policy if you're applying for a new mortgage. It's not going to affect your debt to income ratio. This is not part of that calculation.
Absolutely. And we've seen, gosh, I was trying to think of all the things I've seen people do, or, with policy loans. Of course, most policy loans that are taken, I never know what people are doing with the money because they don't volunteer it, and it's none of my business. But, I've seen people buy farm equipment. I've seen people use it to make real estate purchases. I've seen it, and everything in between. And it's great because those people are able to tap the money quickly. They don't have the arduous process, and they don't have the scrutinization of going through the credit underwriting that you would have to for any of those types of loans.
Right. I realize that for some people there is a degree of difficulty in being told you can kind of do whatever you want. There are a number of people out there who function really well when they're given a lot of guidelines. So traditional lending works well for them because they're told exactly how much they have to pay back and when they have to pay it. And that can create a little bit of a stumbling point for people when they take out a life insurance policy loan, because they usually operate under guidance from someone else, and that's kind of left up to them to figure out when and how they're going to do it. And that can cause some degree of
anxiety, probably.
But that also has a certain number of very, very attractive features to it, in the sense that it's flexible, it's malleable. I've run into situations in the past where people have had outstanding loans and financial circumstances changed on them, unfortunately. And they're in a bit of a worry because they've been paying a set amount for a number of months, and now they don't think they have the money, and they find out, well, you don't have to. And so take some time, figure it out, and we'll get back to it when you can get back to it.
You can resume at any point.
We've always said that life insurance is one of those products that people don't tend to really appreciate until they have it and they see it unfolding in the many different ways that it can. It's one thing to talk about it in theory. It's something else to experience it in real life. Loans are no different.
I agree.
And that's pretty much everything I think anyone needs to know from a basic point of view about life insurance policy loans.
Yeah, I think that was a pretty good, fundamental overview of life insurance policy loans. And if you're done, then I'm done.
Yeah. We're
okay. All right. Well, I'll put in a quick plug here. If you like anything that we have to say, you should head over to ipblive.com. That'll send you over to read some information about a book, along with some really cool bonuses that we have. Our book's called Predictable Profits, subtitled "The 5 Reasons People Actually Want to Buy Whole Life Insurance." So it goes over policy loans are a part of the obviously. But head over to IPB out, and we will be back with you hopefully very soon.